Reader says to AK, I have a contrarian albeit risky view. I expect the fixed deposit, SGS, T-bills, and other fixed income deals to peak soon. Then, they might fall as too much money is chasing yield, and understandably so. This might trigger a correction in the equity market, especially in Singapore. Time and again, we see the bank-dominated STI face resistance beyond 3,200 points and almost certainly falls after reaching 3,400. The STI has just crossed the 200 days moving average and is also above the 50 days and 100 days moving averages. If inflation falls, as it most certainly will, another 5 to 10% upside is easily feasible. Difficult to imagine fixed deposit rates staying high for long. AK says to Reader, technically, the banks are somewhat overbought at this point and price action seems to be grinding or churning at resistance. This doesn't mean that their share prices couldn't go higher, but a correction is probably to be expected and it will present a chance to add if it happens. As for fixed deposit, we will just have to make hay while the sun shines and enjoy the higher interest rates while they are available. If the Fed does what they say they will do, then the higher interest rates could stay high for longer as the aim is to mop up liquidity. There will come a point when there isn't too much liquidity sloshing in the market, but looking at how yields are behaving, we might have some way to go. When we are at that point, we might not have a simple correction in equities as things could get ugly. Don't know how things will look in the future. All I can do is to have a plan which makes sense, at least to me. 1. Stay invested in bona fide income-producing assets that have the ability and willingness to pay me. 2. Stash emergency funds in risk-free and volatility-free products which pay reasonably well.